Jim, some companies have made the decision to self-insure. How does a company make a decision between self-insurance and risk transfer?
When it comes to cyber, for most companies, the loss history is nil. The is nil, but the exposure is very great. So we kind of throw that out, at least that portion of it. We look at the capacity in the markets today. We look at the availability of coverages and exactly what are we covering. Again, the exposure for potential claims, all we can pretty much do is benchmark against what other companies. We're in the financial services business, so we're going to be benchmarking against that. Lowe's is going to be benchmarking against Home Depot, and Coke against Pepsi, and different types like that. When it comes to self-insurance, I really think it's more of a company philosophy on how much you want to actually retain on the books. But it also comes down to, again, as Rebecca said, on budgeting. It's how much your company is willing to budget. I sit on a couple of industry advisory boards, and one of them is made up of very large companies like ING, and it astounds me the difference of how much risk retention companies want to take. I know one company out there, I'm not going to name any, of course, but has a $200 million retention on property alone. We haven't discussed cyber, but I can only imagine. So again, to just emphasize, I really think it comes down to risk appetite.
Jimmy, in the last session, we heard a lot about the SEC guidance, and one of the parts of the guidance recommends that the organization disclose the amount of insurance that they maintain. So have organizations, have risk managers within organizations begun to talk to this about their board? What kind of conversations are going on in an organization about the SEC cyber disclosure guidance?
Those discussions have started. They're mostly in our compliance, in our legal area. One of the things that ING is become very diligent on is complying with things. As some of you know, we're scheduled to go for an IPO next year, so we're having to hit all the marks at all the right times. And one of those in particular is disclosure of insurance. In the past, we've always been able to get away with just saying, well, in excess of, and we can't do that anymore, at least not with the SEC and the others. The discussions are in place, are ongoing, and I'm right now on the periphery of it, only because so many things are having to be kept very quiet for right now. So I'm really not sure what to tell you, but I will say that I've talked to other companies, and if they are not disclosing or ready to disclose it, know exactly what they have, you darn well better be ready for it, because I do know of one company that, especially if you deal with FINRA, that you may get that question on one of your exams. We just did, so that along with fidelity coverage.